You may learn about investing and how to make the best financial decisions for your life on Investor Facts. Make sure you click the subscription button and enable the notification bell if you haven't already. Share, like, and comment. This year on his Twitter feed, Micheal Burry hasn't been hesitant in expressing his opinions about the inflation problems and stock market crash of 2022. But most recently, he reiterated his belief that the index fund and ETF markets are in a bubble. But is it really possible that passive investing will bring down the S&P 500? Let's find out, shall we? To quickly recap, when you purchase a market tracking index fund, you are essentially purchasing a stock that symbolizes market diversification. The assumption is that by purchasing the market, you will eventually get the same return as the market. For context, in 2003, passive structure held about 3.3% of the market. These kinds of figures have recently begun to raise concerns about whether the market's dominance of passive investing is indeed beneficial. He conducted an email interview with Bloomberg on this very subject in 2019 and stated, quote, "Passive investing has eliminated price discovery from the equities markets." What does this mean? It implies that the straightforward hypothesis and model that lure investors into sectors, factors indexes, ETFs, and mutual funds that imitate those techniques do not necessitate the security level examination necessary for actual price discovery. The reason why more and more shares of these major corporations are being retained over time as passive investing gains popularity is not because the investor truly likes the company, but rather because it is included in the index. What eventually results from this? Is the stock price overinflated? The basic performance of this organization is no longer the only factor influencing share purchases. Could a bubble caused by the rise of popularity of passive investing threaten market stability if investors begin to switch in large numbers from index funds to cash? As usual, the solution isn't clear. Consider once again how stock prices actually fluctuate. It's really not that complicated. Since stock prices are influenced by supply and demand, they will rise if many people want to acquire shares but few are prepared to sell. On the other hand, if there are sudden many investors trying to sell but few purchasers, the stock price will drop. Now, each stock has a typical daily trading volume, or the average number of shares that are traded each day. The important thing to remember about daily volume is that stock prices don't really change all that much unless daily volume is suddenly severely perturbed. If the market is collapsing and there is widespread selling, there may occasionally be such a flood of volume trying to sell that it will kill the stock price very quickly. This alludes to a traditional stock market illustration that clarifies daily trade volume. Micheal Burry is concerned that the stock market will experience this. According to him, if things worsen further, many passive investors will attempt to exit the market and return to cash. But if everyone does so in panic, stock values will fall. The problem is that when things go wrong, isolated businesses typically experience this. But what would happen if passive investors who, as you may know, actually own a small portion of everything decided to quit all at once? Well, I assume everything crashes then, right? The impact will be the same for all of the index stocks. On the other hand, even if there is a lot of trading activity going on in and out of these passive funds, there is one thing that goes against that. In reality, this doesn't result in a large increase in trading activity in the underlying companies that comprise the index. How is that possible? Actually, the reason is that passive investors mostly trade back and forth among themselves in secondary market, where the majority of ETF share trading occurs. The first comes from Vanguard and depicts the proportion of ETF trading that either occurs on secondary market or that actually influences the trading volume of the underlying equities. They discovered that the secondary market was used for trade 94% of the time. In other words, 94% of the volume of ETF trading didn't even touch the position of the underlying stocks that make up the ETF. But what if there is a spike in demand for an ETF, or, on the other hand, a spike in selling activity? In those situations, ETF units are created or destroyed, which results in trading in the stocks that make up the ETF. But interestingly, even when you take into account the typical activity of creation and redemption, according to BlackRock analysis in 2017, that still represents a very small portion of trade as a whole. They pointed out that $65.9 billion worth of Apple stock was traded in July 2017, which is cited as the month with the largest inflows of ETFs. Even though 331 ETFs worldwide help Apple, we discovered that at least 95% of the stock's trading volume in July 2017 was unrelated to ETF movements. In spite of the fact that ETFs have been a growing portion of the market over the past few decades, they barely have any impact on the trading volumes of the underlying securities they own. But Burry might still have a point. Micheal Burry, in all honesty, believes that the stock market will collapse within the next 5 years. When the stock market crashes, there is panic, and when there is true panic in the market, frantic selling cycles can occur. You are probably aware when the stock prices fall. A wave of investors may panic sell their holdings, but this raises the selling volume, which drives the share price even lower. Burry's reasoning is that if the market does have a genuine panic moment during which market monitoring ETFs are being panic sold in large quantities, this might set up a negative feedback loop and quickly depress the stock price. Then there is probably a potential that the stock market crisis could be made worse by selling and destruction of ETF units. According to him, the smaller, less traded equities that are still included in many of these major indices are those that are most at risk of duplicating this effect. In 2019, he reportedly claimed, for instance, the majority of the equities in the Russell 2000 index are lower volume, lower value traded stocks. Today, I identified 1,049 equities that traded for less than $5 million during the day, which is more than half, and 456 of those move for less than $1 million. Hundreds of billions are linked to stock like these through indexation and passive investing. The S&P 500 is no different. While it includes the largest stock in the world, more than half of its 266 stocks today traded for less than $150 million. That may seem like a lot, but these stocks are indexed to trillions of dollars worth of assets worldwide. As you enter the world's less liquid equity and bond markets, everything gets worse. It's an extremely intriguing viewpoint, and it does make you question how these larger indexes with smaller cap stocks would do if many passive investors left the market during the next major crash. Normally, when a smaller firm is eventually added to the index, we applaud, but this is an unusual case where perhaps index inclusion isn't such a victory after all. I hope you found this video helpful and you'll consider investing in something more active in the future. Thanks for watching the entire clip. If you like it, kinda let us know by hitting the like and subscribe buttons. Also, don't forget to enable the notification bell so you can be the first to know when we post a new video. In the following video, I'll see you. Goodbye.